Hey everyone, thanks for joining. Andrew here with SmarterHSA. We have a special guest. We're doing an interview once a month with an industry expert. Today we're going to be talking about HSAs with Marlo Peterson of Further.
Oh.
Thanks for joining.
Oh, Andrew, thanks for having me here. I've been in the HSA space since they started back in 2004. I got to kind of think of that George Bush at the time in 2004. This was his first introduction into healthcare reform. And so we'll dive into that a little bit today.
Sure.
So thanks for having me.
Yeah, you're welcome. And you cover the whole state of Minnesota, right?
That's right. Yep. I'm a representative for the company Further. We're actually based in the Twin Cities. We've been in business for about 30 years. We're one of the biggest HSA administrators actually in the country. But yes, I focus on the state of Minnesota.
Okay, so let's start. Take us back to 2004 to present. What have you seen as kind of some of the challenges employers go through when they're looking at implementing an HSA strategy?
Oh, a great question. And that can be a really big answer, but I'll do my best to make it make sense for us in our conversation today. You know, if we go all the way back to 2004, probably a slow start. They were actually, and this is part of the myth today, is that they were a little cumbersome, which they were back in 2004, and really peppered with a bunch of rules. Mm-hmm. And that has changed and evolved so much over the years that HSA administration today is just not an administrative burden, and it's actually not a difficult product for employers to administer. If we talk about some of the challenges today, there is probably the misconception that because you have to have a high deductible health plan in order to have a health savings account, that high deductible health plan is maybe not good insurance or something to that point.
Too much exposure, out-of-pocket risk.
Correct, yeah.
Yeah, I see that all the time. I've tried to move away from even using that term, high deductible, because right away people just think I have such a high deductible that
it's not
insurance, basically.
And so the great point is that our industry is kind of moving to where we're calling it HSA eligible insurance, because really, frankly, most plans today, they do qualify. And they aren't necessarily designated as high deductible, but they do qualify. So yeah, I think HSA qualified is a better way. So there's that myth about the health insurance itself, and then there's that idea that as an employer, they're gonna have to do a lot of extra work. Mm-hmm. And they've gotten pretty streamlined where that's just technology and things have helped, where that's just not the case. And then lastly, that the employee population that works for me may or may not get this. And if they struggle, you know, if we start putting some rules in place or making this difficult, maybe they just aren't going to want to participate.
Yep. Yeah, and you work with all industries. It's not like you're just working blue collar, white collar. I mean, there's not anything specific. And
that's another great point. And so regardless of the industry, blue collar, white collar, and then, you know, there's also this kind of myth that health savings accounts are really for either the young and healthy or the wealthy.
Yeah.
And, you know, those might be obvious, low-hanging fruit. But it's really us in between that we're going to talk about today, that there's some things that really can make a difference in how much it costs to buy our healthcare.
Yeah, and when we sit down and do proposals with employers, with prospects, they're always surprised when we really break down what the out-of-pocket risk is in their traditional plan versus what we're trying to accomplish in the high deductible plan. So, you know, it's always eye-opening.
It is eye-opening, and there's a challenge for employers, I think, is to be able to really do some modeling. And again, I'm not talking about a bunch of work, but when we talk about, there's a few buttons we need to push. It's how much do we as an employer pay for that coverage, or how much of that do we pass down to the employee? And then there is what does the employee, if the employee has incurred some type of medical expense, the value of that HSA. And we haven't talked about this yet, but the most important thing of what we're going to say today is the value of that HSA allows employees to pay for their health care costs with tax-free dollars. And when we say tax-free, a lot of times employees, you know, it might go in one ear and out the other, but I always think it's really easy to break it down like this. We all live in the state of Minnesota. The average person here pays 30% of every dollar they earn in income taxes. If my employer had a way to take money out of my payroll check and move it to a health savings account free of income taxes, I think then, you know, the paycheck goes down by 70 cents, but yet the account goes up by $1.
Yep.
So the simple thing is it allows employees to buy $1 worth of care for 70 cents. That is a tangible, that is a piece that people can wrap their hands around, to know that if I'm at the doctor's office today and the bill is, let's say, $200, but I'm able to pay for it through tax-free money in my HSA, that bill now maybe costs me about $140. And that's the silver bullet here, and that's the way we can get after healthcare costs.
Sure. And then talk about a little bit about the difference between an HSA and an FSA, because that's one we get a lot.
You know, that
is quick.
Yeah, great. Well, FSAs still have a place in today's market, of course, but really being passed up by HSAs. Now, aside from some of those things around, having a eligible health plan and some of the abilities to qualify, there's huge differences. And one of the reasons most employees have always kind of not wanted to participate in flexible spending accounts is that term we've all heard, use it or lose it. And it doesn't take very many times that you actually take your money and set it aside to use it for care, and then, gosh, you did the right thing. You didn't get sick or injured. And that's the best scenario for you, and then you end up losing your money. Well, HSAs take a 180-degree opposite approach than that. So think of it as a bank account that you as the employee own. And if you don't spend the money in your bank account, you certainly don't lose it. It just continues to stay with you. So that's one of the biggest differences. The other one is, when employees actually say, I'm going to commit and I want to participate in a flexible spending account, things throughout the year can change. And maybe they decide that wasn't the right choice for them. Or maybe they decide they wish they would have participated even deeper. HSAs allow the flexibility for employees to start and stop their participation and or how much money they want to set aside as often as they like.
Right.
To me, it's a great feature. It allows a lot of flexibility.
Yeah. So I see that a lot. So another thing I run into a lot is just in general, there's a lot of confusion about how the HSA works from the employee's perspective. So a company they'll have 3 plans. They'll have 2 traditional plans with co-pays, and they'll have a health savings account plan. And typically, I see maybe 25 to 50% of the employees are on the high deductible plan, but they haven't taken the next step, which is actually opening an account. So, or even just they haven't put any money into the HSA. So I see a lot of times where they're just taking it because maybe the premium's a little less, and they're just kind of driving on. But it's not doing justice to anybody.
It's not.
So
you're right.
What are some ways that? What are some quick things to keep in mind for that situation?
So speaking to employers, as in this video, I would say when your employees choose high deductible health plans and then don't follow it up with an account, that really probably in their eyes is just some form of cost shifting. So we've pushed some of the costs as the employer back to the employee. And not that there's not a place for that, but remember the very simple execution of opening up an account. And we can simplify that to the point where employees don't have to actually take action. The employer can really help facilitate that so the employee doesn't have to do anything. But the idea of having a qualified plan without having an account, we're missing out on that number one benefit of not being able to pay for those claims or sicknesses 70 cents on the dollar. So anyhow, that would be one of the, you're really exposing yourself. Now, the other thing on qualified plans, though, and I think this is fair even with or without a health savings account, so I really think it's important for employers to make sure their employees understand this. There are a lot of employees that buy those more traditional plans because they're worried about the future. And that's really what insurance is. But, a great indicator is your past. And what's your health situation been behind you? And so really a lot of people most likely are probably paying for more health insurance than they really need. And so oftentimes by moving to the higher deductible plan, maybe my employer even charges less for that plan, but instead of giving my entire money out of my payroll check for my insurance to the healthcare provider, I give them the portion to pay for the qualified plan, and the difference I keep myself and put into a health savings account. And this way I'm paying for maybe the right amount of insurance.
Sure.
You're familiar with the 80-20 rule? It's true in benefits too. 80% of the population at an employer group really only use 20% of the care. And the 20% are using 80% of the care. And the misconception, of course, again, would be is those 20% shouldn't be in a high deductible health plan. And that's just, I think you're demonstrating, and part of your value you're bringing to these clients is that you can demonstrate how that's not accurate.
Right. Yeah, and then I guess the last point on that example I used where there's a smaller portion on the high deductible plan, there's like that 80-20, there's a large portion on the traditional plan that think this is a better plan, so they're just simply choosing this plan because they think it's a better choice. So they have the income to justify getting a better plan.
Correct.
But they're thinking about it counterintuitively. So
great point.
See that a lot. So a lot of times we can get that shift over to the correct plan and minimize that person's risk, on top of it.
You really hit the nail on the head. And I think, again, the message to, clients and employers is there is no free lunch. And as much as we would just like to put the plan in place and let the employees pick and just deal with this once a year at maybe open enrollment, for an employer to really try to engage their employee population into becoming better users of the healthcare system, and this is what it's gotten to today due to the cost. We just have to be better users. That happens through education. And one of the, again, kind of going back to where we started, what are some of the misconceptions? Employers believe they have to just spend a lot of time trying to teach their employees and try to teach, and that's just so far from the truth. So administrators like Further and myself and partners like you, we really do that heavy lift, and we've been doing that. I mean, the messaging becomes so simple that it's not a lot of education. So employees should be able to take advantage of those qualified plans.
Yeah, so like 5 years ago, I started to see kind of that same scenario happen over and over and over again, like people just not connecting the dots. So what I did is I sat down and said, how can I help employers make this transition and help the employees really position themselves for a much better financial future?
Yeah.
So those 80% of people that aren't using the health insurance can max out their HSA for 5 years, and year 6
maybe
they have a ton of money in their account, versus in the old days they had nothing to show for it when they were using it. And the ones that were high users had money there tax-free to use if they needed it, and they ended up better as well. So
I think you make a good point there.
So really trying to focus on education on first comparing the plans, so
that
knowing
is the biggest piece.
Which plan to
knowing
choose.
How much risk you have and how much it's going to cost you.
Right.
And sometimes the employer and you together have to really lead employees to that answer, because a lot of times they just believe they should pay more for a richer plan, and frankly they probably don't need that.
Yeah, and I have a couple other videos that talk about how people a lot of times will just focus on the deductible of the traditional plan, and they won't look at the co-insurance, they won't look at the max out of pocket.
That's a great point.
So they just automatically see that $1,000 deductible and they're like, that's what I'm taking,
right,
without knowing how to take a closer look. So that was a big thing that we've seen, and it's really made a difference with employers. But then from there, teaching them that the HSA, I mean, we've kind of gone through it already, but teaching them to leverage that to make it even better than.
If you think about the minimum deductible, and this might not be right for your client, but just think about the minimum deductible in order to qualify for an HSA through the tax savings would actually be less than like what you're talking about, $1,000.
Than 95% of the traditional plans. Yeah.
So it's not a foreign topic anymore. I always tell people, I always tell employers that I work with, is it's not a matter of if they're going to move in the direction of a high deductible and an HSA, it's a matter of when. And I think today employers that aren't on board with this, I hate to say that they're doing their employees a disservice, because I don't know what the total package is, but really, in a normal situation when an employee pays for their care dollar for dollar versus paying for your care 70 cents on the dollar, I mean, one of two of those answers is better.
Yep.